Hello everyone, welcome back to my channel. Subscribe to the channel for tech stocks updates. Hold on to your hats folks, because the world of finance just got shaken up. The news is spreading like wildfire, and everyone from Wall Street to Main Street is feeling the tremors. This isn't just a minor hiccup, it's a full-blown earthquake in the financial world. Goldman Sachs and Apple, two titans of their respective industries, are calling it quits on a partnership that once promised to reshape how we spend, borrow, and invest. This collaboration was more than just a business arrangement, it was a vision for the future of financial technology. Imagine the possibilities. Seamless integration of banking services with cutting-edge technology, all at your fingertips. This isn't just another business deal gone sour, this is a seismic shift with billions of dollars hanging in the balance. The stakes are incredibly high, and the ripple effects will be felt across the globe. Investors, consumers, and competitors are all on edge, wondering what this split means for the future of finance. And trust me, when these giants sneeze, the whole market catches a cold. The financial ecosystem is incredibly interconnected, and a move like this sends shockwaves through every sector. From stock prices to interest rates, everything is in flux. The uncertainty is palpable, and everyone is scrambling to make sense of it all. So, buckle up as we break down this high-stakes split and what it means for your money. We'll dive into the reasons behind the breakup, the immediate consequences, and the long-term implications. Whether you're an investor, a tech enthusiast, or just someone who uses a credit card, this news affects you. This is about more than just credit cards or savings accounts. It's about the future of fintech. The partnership between Goldman Sachs and Apple was a bold experiment in blending traditional banking with modern technology. Its dissolution raises questions about the viability of such collaborations and what the next wave of financial innovation will look like. Get ready for a wild ride. The financial landscape is changing rapidly, and this split is just the beginning. Stay tuned as we navigate through the twists and turns of this unfolding drama. The future of finance is uncertain, but one thing is clear. It's going to be an exhilarating journey. Rewind to 2019. The financial world was buzzing with anticipation and speculation. Apple, the tech behemoth known for its sleek gadgets and innovative technology, wanted to dive deeper into financial services. They had already revolutionized the tech industry, and now they had their sights set on finance. They teamed up with Goldman Sachs, the Wall Street powerhouse known for its financial acumen and expertise, to launch the Apple Card. This partnership was more than just a business deal. It was a strategic move to blend technology with finance. This wasn't just another credit card, it was a status symbol, seamlessly integrated with the Apple ecosystem that millions swear by. The Apple Card promised simplicity, transparency, and a user-friendly experience, all wrapped in the sleek design that Apple is famous for. The goal was simple: conquer the world of consumer finance. Apple aimed to make financial transactions as intuitive and effortless as using an iPhone. They wanted to change the way people think about and use credit cards. Goldman Sachs would handle the boring stuff: lending, risk management, and the complex financial operations, while Apple provided the cool factor, the innovative technology, and its massive, loyal customer base. It was a division of labor that played to each company's strengths. It was a match made in heaven, or so it seemed. The collaboration promised to bring a new era of financial services, combining the best of Silicon Valley and Wall Street. The world watched closely as these two giants embarked on a journey to reshape the financial landscape. But as with many high-profile relationships, trouble was brewing beneath the surface. Whispers started circulating about disagreements over strategy and profits. Apple, used to calling the shots, reportedly chafed at Goldman's more traditional approach. Meanwhile, Goldman Sachs, eager to prove itself in the tech-savvy world, may have bitten off more than it could chew. Integrating with Apple's notoriously closed ecosystem proved more challenging and costly than anticipated. The honeymoon phase was officially over. Now the million-dollar question, or should I say dollar question, is, who stands to lose more? Goldman Sachs, which poured significant resources into building out its consumer banking arm, or Apple, which risks losing some of its fintech momentum? The answer, my friends, is far from simple. Analysts are busy crunching numbers, and the estimates are enough to make your head spin. But one thing's for sure, this divorce won't be cheap for either party. Mayo's warning shot. Mike Mayo, a well-respected bank analyst, and let's just say he doesn't mince words, has been sounding the alarm bells on Goldman's consumer banking ambitions for a while now. Mayo has built a reputation for his candid and often critical assessments of the banking industry, and his latest target has been none other than Goldman Sachs. His warnings have not been subtle, and they have certainly not gone unnoticed in the financial world. He's pointed to mounting losses and questioned whether Goldman has the stomach for the cutthroat world of retail banking. Mayo has highlighted the significant financial challenges Goldman faces as it tries to carve out a space in the highly competitive retail banking sector. He has raised concerns about the sustainability of their consumer banking strategy, especially given the increasing losses that have been reported. According to Mayo, these losses are a clear indicator that Goldman might be out of its depth in this new venture. Mayo's take? This breakup could be a blessing in disguise for Goldman, allowing it to refocus on its core strengths: investment banking, trading, and wealth management. He believes that by shedding its consumer banking ambitions, Goldman can return to what it does best. Mayo argues that the firm's expertise in investment banking, its prowess in trading, and its strong foothold in wealth management are where its true strengths lie. By concentrating on these areas, Goldman can potentially enhance its profitability and reinforce its market position. Ouch! That's got to sting a bit over at Goldman Sachs headquarters. The idea that their foray into consumer banking might have been a misstep is a tough pill to swallow. However, Mayo's insights suggest that this strategic pivot could ultimately benefit Goldman in the long run. The leadership at Goldman Sachs will need to carefully consider these points as they navigate the future of the company. The financial world will be watching closely to see how this unfolds. Goldman's pivot. So, what's next for Goldman Sachs? Don't expect them to slink away with their tail between their legs. They've already hinted at a strategic shift, pulling back from some consumer-facing ventures and doubling down on areas where they have a clear advantage. Think high-net-worth individuals, institutional clients, and, dare I say it, even more deals in the world of technology and innovation. This breakup might just be the kick in the pants Goldman needed to reclaim its Wall Street dominance. Wall Street reacts. As you can imagine, news of the Goldman-Apple split sent shockwaves through Wall Street. Goldman Sachs' stock took a hit as investors grappled with the uncertain future of its consumer banking division. But hold on. Before you hit the panic button, remember that the market loves a good turnaround story. If Goldman plays its cards right, this could be an opportunity to emerge stronger and more focused than ever before. The JPMorgan Factor. And what about JPMorgan Chase, you ask? Ah yes, Jamie Dimon's empire. Well, they're reportedly waiting in the wings, eager to snatch up Apple's business. Word on the street is they're already in talks to take over the Apple Card and other financial products. JPMorgan, with its massive scale and existing consumer banking prowess, seems like a natural fit for Apple. But hey, this is Wall Street, so expect plenty of twists and turns before any deal is inked. A new era in Fintech. One thing's for sure, this breakup marks a turning point in the world of Fintech. The dream of tech giants seamlessly integrating financial services into their ecosystems has taken a hit. But don't count big tech out just yet. They're still sitting on mountains of data and have armies of brilliant engineers. This setback might just force them to rethink their strategies and partnerships, leading to even more innovative and disruptive financial products down the line. The final word, your take. So there you have it, folks, the end of an era and the beginning of, well, we'll have to wait and see. Is this breakup a win for Goldman Sachs in the long run? Or a costly misstep? Only time will tell. But here's what I want to know. What do you think? Head over to my Twitter and sound off. Let's get this conversation started. Because in the world of finance, knowledge is power, and together, we can make some serious money.